Hi, we're talking about Your Money Matters on NDTV Profit, and I'm Alex Matthew. Today I'd like to talk to you about what happens with the interest rates being cut. Of course, the context is important. First, in February, the RBI cut the repo rate by 25 basis points, and its stance remained neutral. And then last week, on the 9th of April, the repo rate was cut by another 25 basis points to 6%. And the stance was changed to accommodative. And what this means in monetary policy parlance is that there are only two options that will be considered by the RBI going forward. Either the rates will be kept unchanged or they will be cut further. That stance takes into account the fact that inflation has been coming down, and that allows them more elbow room to cut the rates further. In fact, estimates are pointing to a further 50 basis points of cuts, the first of which could take place as early as June. Now, what does that mean for you? On the first half, which is on the deposit side, you already have a few banks that have started cutting rates. In fact, just recently you heard that HDFC Bank had cut its savings account rate as well by 25 basis points, and a few other banks have announced term deposit rate cuts. Not all of it has been transmitted, remember, and that will take place over the course of the coming weeks. On the loan side, every loan that was issued with the EBLR, that is the external benchmark linked rate, will transmit very quickly, that is in a month's time. And all new loans will automatically have the lower rates fitted in to the rate that is offered to you. But the older loans, which are on the MCLR or marginal cost of funds lending rate, which is most of the loans in the system right now, will take longer to see that rate reduction. So what should you do? Lenders will offer you two options whenever the rate reduction takes place or interest rates are cut. One is to keep the EMI the same and to reduce the tenor, and the second is to reduce the EMI or keep the tenor unchanged. The higher EMI, remember, will always be more beneficial because the higher EMI would mean that your interest cost would be lower. A longer tenor would significantly increase your interest outgo. Now, a sizable reduction in the interest rates is an opportunity for you also to consider getting a better deal. You could approach other lenders and shop for a loan, but there is a one-time charge involved as well. So that's something to bear in mind. We'll talk about that. For deposits, the biggest risk that you need to account for, and we'll talk about this as well, is reinvestment risk. This plays out if interest rates move down while the FDs are still running. So you need to consider whether you need to lock in as of now. In fact, that's what I want to start with as the first question with my first guest today. Joining me is Vishal Dhawan, the founder and Chief Executive Officer of Plan Ahead Wealth Advisors. Vishal, thanks as always for taking the time. And when it comes to fixed deposits, that's the first aspect that I want to cover today. The big risk, as I see it, is reinvestment risk, which is that if you invested at the peak of the interest rate cycle, and if you have a 2-year or 3-year fixed deposit running currently, and if interest rates are cut further, they've already been cut by 50 basis points, then you're losing out when you have to reinvest. How do you counter that?
So it's a very, very critical point, I think, which gets missed by a lot of investors because there is a tendency to look for the right side of the fixed deposit menu, which is the interest rate, and less at the left side of the menu, which is essentially the tenure of the deposit. So I think one of the things that investors want to do when they think about trying to reduce this risk, I don't think you can completely eliminate it, is to have a set of deposits which mature at different points in time, because it's very hard to predict at what point the interest rate cycle will turn. And as we all know, interest rates are not determined only by what happens domestically in your country, but also depend on what happened globally or what happens globally. So clearly there is a need to be able to segregate these two things and try to create deposits which are laddered, which essentially means that you have money essentially sort of for different tenures of time. So the way to do this in the current environment, for example, if you haven't done it already, is to say that if your expectation is interest rates will go down, then what you do is you look at longer term deposits today, along with a sprinkling of shorter term deposits. So let's say, if a 3-year deposit or a 4-year deposit gives you a certain rate of interest, and your 1-year deposit gives you a slightly higher rate of interest, it's okay to still go with the longer term deposit because you want to try to eliminate this interest rate risk and the reinvestment risk. If the reverse is happening, where your shorter term rate is actually lower, uh, and the or higher, whichever way you want to look at it, you do want to keep in mind that by ensuring that the deposits mature at different points in time, you have the flexibility to be able to, as and when they mature, reinvest at what might be good rates at that point. And laddering, therefore, is a very, very critical part of fixed income investing. The second way to deal with this reinvestment risk is to try to use different instruments which also either lock in interest rates or have flexible interest rates. And if you look at, for example, a PPF account, while a lot of people think that it's a fixed interest rate, it's actually not, because the interest rate changes every year. And therefore, it's not a fixed interest rate, unlike a deposit, which is actually a fixed interest rate. So I think you tend to use a combination of these two strategies to try to deal with both interest rate risk and reinvestment risk.
Okay, so you've answered that question. Now, when it comes to the current context, Vishal, we've seen 2 rate cuts already, and the most recent one, of course, was very recent. And so not all of the cut that has taken place at the central bank level has flowed into the system in the form of deposit rate cuts. I'm sure you have one eye on what banks are doing. So when you are advising your clients at this juncture, what are you advising them to do given the deposit rate scenario?
So again, we need to keep in mind that transmission of interest rates will always take its own time, especially on deposits, while it happens much quicker on the loan side. And therefore, for investors who haven't actually put their money away into deposits yet, they may want to keep in mind that there could still be a window for them to be able to lock in at these interest rates, even though they may be slightly lower than what they were 6 months ago. Do keep in mind, though, that you don't overextend yourself in trying to lock into this deposit rate, because sometimes what we find is that if you're in an environment where, for example, there's a lot of uncertainty around other asset classes like equity, and therefore there's a natural tendency to want to go towards fixed income kind of assets, especially fixed deposits, and you think that you're on an interest rate cycle where interest rates are going to get cut further, you could actually end up forgetting your financial goals itself and end up allocating all that money into fixed deposits at this point. So don't forget that there are financial goals which drive a lot of this. Once you're clear that these are my lengths of time before which I require capital or money, then I think you can break it up and take advantage of the fact that interest rates may still continue to move downwards, unless the inflation trajectory that has so far been downwards starts to suddenly take a ugly turn because of what's happening with tariffs globally.
Yeah, and generally you would anticipate that 2 to 3 years is what a cycle would take, interest rate cycle. There's no way to predict it, as you've pointed out, but traditionally you've seen 3-year cycles play out on interest rates between peak and trough and back again. But senior citizens have fixed deposits as a favored product for obvious reasons because of the safety involved. And this year, Vishal, when it comes to interest earned, they're much better off if they don't have any other source of income because of the change in the tax treatment. Should they double down on fixed deposits because of the rate that they are still available and the fact that they are going to be paying less tax?
Yeah, I think it's certainly an option for senior citizens to think about, because on one side, inflation is seeming to be much lower than what it's traditionally been, as we can see from even the recent data coming out. On the other side, you look like you're still at the relative start of an interest rate cut cycle, and the transmission has not happened yet of even the rate cuts that have happened. And thirdly, because of the fact that tax slabs have got expanded, there is much more income that can actually come to you. So our suggestion would be that senior citizens look at fixed deposits, look at the senior citizen savings scheme if they don't have their allocations used up there as well. So they try to lock into some of these rates to their advantage, and and do not forget, though, while they're locking in, that they also ladder, because in their next interest rate cycle they will probably end up figuring out that, again, when the deposits mature, they won't be sure about whether that's at the bottom of the cycle or the peak of the cycle. In fact, one of the things that also gets very, very much lesser attention is the fact that while you have interest rate cycles which go down and go up, there are also very long periods in which nothing happens with interest rates at all. They just remain flat and plateaued around a certain level. And those are also actually very good times for investors if those interest rates are generally at a point where interest rates are high and inflation is low. And that seems to be the situation that we're in currently, where both of these things are working in favor of investors.
Yeah. Okay, fair point. Let's go to the other side of the playing field, if you can call it that. We've been talking about deposits. Let's talk about loans, because this is where it becomes absolutely crucial. A lot of people are taking loans now, and automatically, Vishal, they are on the external benchmark linked rates, which means that every month there is a reset, and so the reset takes place very quickly. Let's first address that. As we understand it, there's not still a very large percentage of the overall loans in the system that are EBLR. There are a lot of them that are older loans, and so therefore they are marginal cost of funds lending rate, which resets at a longer duration. So first, for EBLR, if you have two options, of course. One is you can keep your EMI the same and you can reduce your tenor if the interest rates are going down, or you can reduce your EMI and you can keep the tenor the same. Which is better and why?
So I think it's very clear that if your cash flows allow it, and you're not feeling overwhelmed by the overall financial plan that you have in terms of the EMI payments that you're making, then you should try to keep your EMI constant in a falling interest rate environment and let the tenure actually reduce as a result, because the entire saving on interest in that scenario is likely to be much more substantial and rather than otherwise. In fact, it's also coincidentally the time where a lot of individuals do end up getting their bonus payments or the variable pay. And it's also a great idea if you can use some of that bonus or variable pay to actually pay down your loan through a prepayment, and at the same time keep your EMI constant, because then that becomes a double benefit that can come to you, where you get the benefit of lower interest rates plus the variable pay, reducing your overall interest cost.
Okay, fantastic. And it's a basic thumb rule to follow. The lesser time you are spending repaying a loan, the lesser is the interest burden that you will bear. Vishal, as interest rates go down, it's also a great opportunity for you to go and shop for a better loan or a better deal. What should you bear in mind when you're doing this?
So there are a few things you need to keep in mind. One is that if you expect interest rates to continue to go down, then you may want to wait a little bit before you go and look at refinancing your loan with maybe another lender, or even going back to your current lender and telling him that you want a lower interest rate than what is currently there, simply because you're expecting over the next 6 months that rates will go down further. In any case, our suggestion would be that, when you're doing this this sort of approach, you do keep in mind that this is going to be one interest rate cycle which will play out. And especially if you have long tenor loans like home loans, there will be multiple cycles that will play out, some of which will be flat interest rates, some of which will be reducing interest rates, some of which will be rising interest rates. And therefore, refinancing your loan and looking at it carefully is a repetitive process and not a one-time process that a lot of people think about, saying, I just need to take my loan and then forget about it and just ensure that I pay my EMIs on time. So that's one thing to keep in mind. The second is typically when you refinance, um, whenever you choose to, whether it's now or after 6 months, you will end up having to very often pay a fee for refinancing. And there could also be additional costs associated with paperwork. And these costs can range typically anywhere between 0.3 to 0.5% of your overall loan cost. Besides just the administrative work around doing it. So if the difference is not enough to justify that 0.3 to 0.5% extra cost, then you may not want to go for it. However, keep in mind that this 0.3 to 0.5% cost is a one-time cost.
Yes.
It's not a recurring cost. So don't just compare a 0.3 to 0.5 as a one-time cost versus a 0.3 to 0.5% saving on interest rate cost per annum.
Yeah.
Because very often we see people do that.
Okay. We're running out of time, but there's one important question which I haven't asked, which I have to ask, Vishal. So quick answer here. If you have a loan that is running on MCLR, possibly if you have a home loan in particular, should you shift to EBLR?
Most certainly. I think, irrespective of where you are in the cycle, I think an external benchmark lending rate is very transparent. And I think it helps people plan very easily for their finances because they know that if interest rates will go down, their loan rate will go down proportionately and vice versa. With an MCLR, there are so many other factors that come into play in terms of the bank's own operational cost, balance sheet, etc., that also play a role. And therefore, you never really know what will happen when interest rates go down or go up. And clearly, in a world where everything is more transparent and EBLR works much better.
Okay, fantastic. Vishal, thanks as always for taking the time. Pleasure speaking with you.
My pleasure.